Good evening, ladies and gentlemen. This is Barry Norman on behalf of CMS Trader, and welcome to our class on MACD. That's Moving Average Convergence and Divergence, the secret trading indicator. It is one of the best indicators in the marketplace. Now, today's class is sponsored by CMS Trader. That is Capital Markets Trader, www.cmstrader.com. Now, if you want, while we're in class, you can go set up a demo account and use our advanced charts and follow along in as I show you how to put MACD up and set it up on the charts right there if you wish. Now, because CMS Trader is a regulated provider, I'm required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure that you fully understand the risk and take care to manage your exposure. Now, tonight, any assets we do talk about are for educational purposes only. And remember, this is Sunday, so the markets are actually closed. So if you go to www.cmstrader and just click on the buy or the sell button, it'll open up a little window, and I think you just have to put in your, pick a username with your email address and a password, and you'll have a demo account up and running, and you can use their advanced charts and follow along with us in class. Now, CMS Trader is one of the world's leading providers, and they have extensive education. They have all types of security. Your funds are all guaranteed because they are a regulated provider. You have no dealer intervention and no conflict of interest between the broker and the trader. You have many different styles and many different trading accounts with a whole bunch of features and technical analysis that will make you the best trader you can be. You can also trade a wide range of instruments with CMS Trader, from Forex, CFDs for stocks, commodities, and indices. You can also use their social networking to follow along with their watch, copy, and profit just by joining social trading and copying the most successful traders with one click and increase your profits. And lastly, you can sign up to become an independent trader with CMS Trader and get one-on-one sessions with a financial expert, their ebooks, and all their tutorials to help you become an independent trader. Now tonight, we will be discussing MACD, Moving Average Convergence and Divergence. So let's get started. Now, I've done this class many, many times, and I've reworked it and rewritten it as many times as you can possibly imagine. The reason that I have difficulty is because MACD uses many lines in its setup, and I have to explain to you how each one of these lines is developed. And it just takes a lot of words to do this. And I've tried to figure out a better way to do it, and every time I end up with the same thing. So we'll get through it tonight, because even though you don't need to do any of the calculations, because MACD is one of the leading indicators and it's just dropped on your charts for you, you have to understand the foundations. And by understanding how each line is calculated and where each line in this indicator comes from, you'll have a better understanding, so you'll be able to use it more successfully. Now, the MACD indicator was developed by Gerald Arpel in the late 70s. And as all of us know, in the late 70s, we only really had the stock market out there. So it was developed primarily for the stock price, and it was used to spot changes in strength, direction, momentum, and direction of a trend in a stock's price. It gained huge popularity, and then because it was so popular, it was redeveloped and used for Forex trading and CFD trading, and it works in every single market. The MACD is one of the most popular and broadly used indicators for Forex trading. The letters MACD is abbreviation for Moving Average Convergence and Divergence. The MACD indicator, which requires moving averages as its input, falls into a group of what we call lagging indicators. The basic function of the MACD Forex indicator is to discover new trends and to help identify the end of current trends. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now tonight we're going to learn how to use it with the standard formulas that Gerald Arpel developed this for that work extremely successfully in all marketplaces. Now, there are many ways to use this, but trading divergence is one of the most popular ways to use MACD. So we can use it for convergence, we can use it for divergence, and we can also use it for overbought and oversold markets. And we'll talk about all of these ways to use it. It'll also generate entry signals and trade signals. Okay, the MACD indicator is typically placed at the bottom of the trading chart in a separate window beneath the price chart. The moving average convergence divergence is a relatively easy to use tool. However, it is crucial to understand it fully before attempting to trade using its signals. So here we go. And I will explain it to you in words, and I'm going to show it to you on a chart. But I'm going to, like I said, I'm going to explain it to you with as little words as possible, but it does require a little bit. So follow along. Because the first thing we develop, the first part of it is two lines that are actually put on the price chart. And these are two moving average lines. One is at a 26-day moving average, and one is a 12-day moving average. Of the two moving averages that make up the MACD, the 12-day is obviously the faster one. Why? It's a shorter period of time, so it will adjust quicker to new prices. With a 26-day is slower because it's averaging out 26 days, so it adjusts slower. So 12 is faster, 26 is slower. In their calculations of their values, both moving averages use the closing price of whatever period is being measured. So let's start with this first. And let me take you over to a chart I've got set up. And let me pop it up on your screen. And here we go. Okay, so don't look at the bottom half of my screen. Only look at the price chart where the bar charts are. And you can see on here, I've colored them in yellow and green. Okay. These are the two moving average lines. One is a 12-period moving average, and one is a 26-period moving average. Now, the green is the 26 period, so it is the slower. The yellow, and I've just used these colors so I can use them to describe to you, and the yellow is the 12-day moving average, so it is the faster. So they are just simple moving averages placed on a chart. Everybody follow me? Now, for those of you who get mixed up in what a moving average is, or when we talk about a 12-period or 12-day moving average, in this case I've got a 1/2 hour chart up here. So that means 12 bars would be used for the calculation of the 12-period moving average, and it'd be the close of each of those 12 bars. And for the 26 period, we would use the last 26 bars and the close price. And this is the standard that's done, developed by Gerald Arpel, who developed this in the 70s. And we're only concerned with this method he developed and the strategies that he developed. Guys, I would appreciate it very much if you stop writing in questions. Okay. I will answer all of those throughout the class, but asking me just because your brain says I want to know that now doesn't help me get the class to you correctly. So I guarantee you every one of those questions you popped up will be answered, so just listen. At the end, if I haven't answered it, I'll be glad to answer it again, okay? So we have the yellow and the green lines on the chart, and we're using a 30-minute chart, and we're using a 9 and a 12 and a 26 moving average. This is the very first step in starting your calculations for MACD. But MACD is not placed on a chart. It's placed below your chart. So what we do is we calculate these two numbers for the 12 and the 26. Then we subtract the 12-period moving average from the 26-period moving average. And we then plot that on our chart. We also average a 9-day moving average from these moving averages. So let's go back to my explanation. We'll come back to the charts to do. Right now, all we have is the yellow line and the green line. 12-period moving average, 26-period moving average. Okay. So that's where we start with. Then we move to, in the calculation of values, both moving averages use closing price of whatever time period is measured. On the chart, a 9-day EMA of the MACD itself is plotted as well. It acts as a trigger for buy and sell signals. The MACD generates a bullish signal when it moves above its own 9-day EMA, and it sends a sell signal when it moves below. So the first thing we do is we take the so now we have the 12-period moving average and the 26-period moving average. Okay. We take these off the chart and we then put them on the bottom chart. We do this by the name is based on the lesser moving average of the price continually converging or diverging from the greater moving average price. The default setting for the two of these is 12 and 26 respectively, and with a 9-period moving average applied to the difference of the two used as a signal generator. The moving average used to construct the MACD can be simple, weighted, or exponential. Although all work, the exponential is preferred. So what we do is we take the 12 and the 26 that we plotted on the chart, the yellow and the green lines, and we subtract them. Once we subtract them, we then plot them on the bottom of our chart, the difference. Hold on a minute, let me pop up the chart here. We plot them on the chart below. So what we have on this chart below here is we have a zero line. The zero line is right here. We take the difference between this line and plot it on here in this blue line. And I've just made it blue. The blue line is known as the MACD line. So all it is the difference between the 26-day and the 12-day moving average. Now, what do you think happens when the 12-day and the 26-day moving average cross over? Well, when they touch each other, what's the difference? It is 0. So on this 0 line here, what will it be? It will be a 0. Okay. As they separate, they might be a 1, a 2, a 7, a 9, whatever the difference is. We plot that on this chart, and we keep plotting it on the chart to form this line. It's simply the difference between the 12-day and the 26-day moving averages, which are just numeric values. Even though we plot them on a chart, they're simply calculations. We subtract the calculations and plot it on this chart. Okay. Therefore, we no longer need the moving averages on our over top of our bar chart. So they don't exist. And when you use MACD, you don't have the moving averages on your chart because they are then contained in this blue line. So moving averages we don't pay because we don't care where the moving averages are moving. We only care about the difference between the moving averages. When they're positive, the fast moving average is moving faster than the slow moving average. When the slow moving average slows down because the price is kind of steady, the longer moving average, the 26-day will overweight it and it'll go down to negative. And Therefore, all we have to do is see the movement of this line above and below the zero to know when it crossed over each other on the chart above, and whether they're moving separate or together, whether they're getting higher or lower. So this is the first line that we put on this chart below. And this is called the MACD line. The next line we put on this chart is the red line. And this is just what I've color-coded them for you. But the next line is called the MACD signal line. The MACD signal line is simply a moving average, an EMA, an exponential moving average of the line above it. So we took the MACD line, which is the difference between the two moving averages, and then average that out over 9 days or 9 periods. We would plot that on our chart with the red line. That is known as the MACD signal line. So we have the MACD line here and the MACD signal line here. So what do we use? We use 4 different calculations. We've used a 26-day moving average and a 12-day moving average. We subtracted the 26 from the 12 and plotted that as the red line, and then we have taken we plotted that as the blue line, and then we've taken the average of that number, which is the difference, over a 9-day EMA or 9-day moving average, and plotted that on the chart also. And that gives us our 2 lines. The moving average line of the 9-day moving average is called the MACD signal line, and the blue line, which is just the differential or the difference between the 26 and the 12-day, is called the MACD line. So we have the MACD and the MACD signal line. Okay, I told you, I warned you guys, there's a lot of words here. So let me take you back over to the PowerPoint, and I have an easier to see chart with this explained on a chart. So let's take a clear look. So we start out with the 12 and the 26 moving average. Okay. And the 12-period EMA moves down faster than the 26-period moving average. We would then see it separating down below. As the rate decline slows down, the 12-day begins moving above and towards the 26 EMA. But we take these and we plot them on this chart down here. So MACD moves lower, showing that the divergence between the moving averages, or the MACD moves higher, showing you the convergence between the moving averages. Okay, so what do we have? We have the MACD line, the blue line here, and the MACD signal line. So the MACD line right here is the difference between the two moving averages, and the MACD signal line is the 9-day moving average of the line, the blue line above it. Now, the thing about MACD is it works in all types of markets, and it is unlike some signals that only work good in short-term or long-term markets. MACD will work well on whether you're using a 30-minute chart or a 2-hour chart. It'll work well in long-term investments and short-term. It is that flexible because it's taking into account when you move to a 9 or you move to a 1-hour chart from a half-hour chart, you're still taking 12 and 26, not day, but bars. So that's taking a longer period. So it's self-adjusting depending on the time frame that you are looking at. So MACD works in all markets, and it works on all time frames. So it's very rare that you find signals that work well in short-term time frames, and MACD does extremely well. So it is a derivative of a derivative. So we have the 2 moving averages, which are actually the first derivatives because of the average of the price. So we have 2 derivatives. Then the MACD line is the 3rd derivative. The MACD signal line is the 4th derivative because at each step it's calculating 1 step farther away. So how do we get that? So we start out with, and I'm going to reiterate this till we get it all down pat. When the 12-period EMA crosses below the 26 EMA, MACD crosses below the 0 line. Okay. When MACD period EMA minus the 12-period EMA, it crosses below. Then we have the 9-period EMA, which is called the MACD signal line. So we have the MACD line here. We have the MACD signal line. And then we move on to the last step, which is called the histogram. And the histogram is a derivative one step farther. The histogram is the difference between the MACD signal line and the MACD line. So it's the difference between the red line and the blue line below. Again, it is plotted on a chart that's called a histogram, which are simply bars going up and down. Now, when the 9-day EMA, when the signal line and the MACD line cross each other, again, what is the difference? It's a 0. So the center line is 0. So when it is at the histogram at 0, you know one or two things. Well, you know one thing, that the lines have met. Correct? Because they're 0. When you subtract one from the other and the 0, means they're at the same place. If it moves above, means that the MACD line is moving higher than the signal line. And if it moves below, it means that the MACD line is lower than the signal line. So we can get rid of basically everything and only look at the histogram, which takes in effect every one of these lines and breaks it down and puts it on to this one bar chart. That's why nobody puts the moving average lines on their chart, because the MACD line takes into account those, the MACD signal line takes into account the average of those, and then the histogram is the final calculation of everything wrapped together to tell you how the asset is moving. Okay, so I warned you, it's a lot of words. But you have to understand these. You don't have to do the calculation because MACD is dropped on your chart for you automatically. But to do the interpretation, you have to. So the MACD signal line, is a 9-period moving average of the MACD line. The MACD line is the difference between the 26 and the 12-day moving average. So MACD can be helpful for noticing potential changes at very early stages. However, if we wait for the 0 line crossover, MACD to cross the 0 line, we are essentially trading a moving average crossover, which is inherently lagging the market and may not be an optimal entry point. This is where the signal line comes into play. Because we were just doing the trading from the blue MACD line, it's simply the crossover of the two moving averages of the 12 and the 26-day moving average. The signal line is simply a moving average built on the value of the MACD line. By default, the value is a 9-period. Building on the relationship of the MACD line itself, traders very often look for entry opportunities when the MACD line crosses the signal line. When the MACD line crosses above and over the signal line, it is looked at as a buy signal. When the MACD crosses below the signal line, it's often looked at a sell signal. Okay. So this is where we start generating our buy and sell signals. So when the MACD, which is the blue line, crosses down and below it's the red line in this chart, crosses down and below the signal line, it is a sell signal. When it crosses above and over, it's a buy signal. So it's when the MACD line crosses the signal line going up, it's a buy signal. When it crosses the signal line coming down, it's a sell signal. And this is the first part of information generated by the crossover of the MACD and the MACD signal line. In an effort to more closely follow the relationship between the MACD and the signal line, traders can follow the histogram, because the histogram is the calculation of the difference. And the histogram, which is simply a bar chart plotted around the zero line to indicate the relationship between the MACD and the MACD signal line. Notice in this graphic, when MACD crosses the signal line, the histogram will appropriately cross the zero line. When the MACD crosses up and over the signal, the histogram will climb above zero. So what is this? When the MACD crosses up and over the signal line, it's a what? A buy signal. And when the MACD crosses down and below the signal line, the histogram will drop below the zero line. And what is it? It's a sell signal. So we have the MACD histogram, the MACD, and the signal line all put on our chart. Now, there are three different stories that we can find in the MACD. Okay. The MACD proves most effectively in wide swinging trading markets. It is one of the indicators that works best in active volatile markets. There are three popular ways to use moving MACD: crossovers, overbought and oversold conditions, and divergences. So the first we'll look at is the crossover. The crossover occurs when the MACD line crosses over the signal line. Okay. And it will generate buy signals, and hence the other way it will generate sell signals. So when we look at this on this chart here, we can see when the MACD line fell below the MACD signal line, dropped through and fell below. You need the crossover first. At that point that it crossed, gave us a sell signal. At this point, it crossed back above and gave us a buy signal. Here it crossed below. Here it crossed below. Here it crossed above. Here it crossed below. Now the thing is, MACD will generate a handful of signals, because in a fast-moving market, you're going to have lots of crossovers. The unfortunate part is a lot of times they're false signals, or the signals are so short, or they won't generate any pips for you. Okay, so you have to use more than this to buy or sell. You have to use some true analysis, because they don't offer many false signals, but if it doesn't give you enough pips to make a difference, then it's not worth being in the marketplace. So you have to use this with a grain of salt, but it does give you solid buy points and sell points. But you have to determine how far you expect that swing to take you. So we can see here on this chart, it generated a sell signal. You don't need to look at the lines. You don't need to look at the moving averages on a chart. You're simply looking at the histogram. The histogram touched zero and then it fell below. Okay, generated the sell signal here. The markets fell beautifully. Here it generated a buy signal. Markets did beautiful. Here it generated a sell signal. Markets did nicely. Here it generated a buy signal. The markets eventually climbed. Each one of these signals would have been valid. Now we're looking at long-term charts, where over here we were looking at a long-term chart also. Okay, it works in short-term or long-term. The next is generating overbought and oversold indicators. Now the thing about overbought and oversold indicators is they're not entry or exit points. They tell you when a trend is about to end, because an overbought market can continue to be overbought, and an oversold market can continue to be oversold. So they're warning you that the market or the trend is about to take place, or it is too heavy at this point. So MACD is useful as an overbought, oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, it is likely that the symbol price is overextending and will soon return to more realistic values. So we can see this plotted on the chart below, and we can see the wide swings. When we get these very wide swings, it's telling us, but they have to be dramatic. They have to be long. They're not small. And they're telling you the market is overbought or oversold. Okay, that becomes a bullish or bearish warning, but not a trade. Now, divergence is one of my favorite ways of using this. And too many people think the word or the use of divergence is simply when the two lines diverge from each other. But that's not the case. It's not when the signal line and the MACD line are diverging, because we're only trading crossovers with this MACD. The divergence occurs between the chart price and the trend price on the chart and the trend price or the trend on the MACD line. Okay. When we see the MACD line making higher lows while the chart is giving us lower lows. So in other words, what we see is a downtrend on a chart. So we're seeing lower lows, and on the MACD indicator down below, what we're seeing is higher lows. So you see below, while the trend on the price chart is down, the trend on the chart below the MACD signal line, the MACD line, is giving us higher lows. Okay, that's giving us what we call divergence. The price chart is diverging from the indicator. An indicator that an end of the current trend may be near occurs when the MACD diverges from the symbol. A bullish divergence occurs when the MACD convergence indicator is making new highs while price fails to reach new highs. A bearish divergence occurs when the MACD is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold levels, because this will help you. Remember, I told you oversold markets can remain oversold and overbought markets can remain overbought. But if we get the overbought or the oversold indicator and then we get a divergence, guess what? You've got the end of a trend. But now you're looking at double information. So here we have it more defined. This is bearish divergence. So we see that the price chart here is making higher highs. We're actually in an uptrend. Where on the MACD chart, the MACD line is making lower highs, or the trend line is falling down. At this point, when we get that crossover, we know that that trend is dead. So it's giving us very important information. So a bearish divergence forms when a security records a higher high and the MACD line forms a lower high. The higher high in the security is normal for an uptrend, but the lower high in the MACD shows less upside momentum. Even though upside momentum may be less, upside momentum is still outpacing downside momentum as long as the MACD is positive. Waning upward momentum can sometimes foreshadow a trend reversal or a sizable decline. Now, we can use this in connection with support and resistance trend lines and volume on our charts for a very strong signal or very positive piece of information, because this is an indicator that is very, very helpful, and it gives us very strong warning. If you start using it, you'll find it is very accurate. So most traders only look after time at the histogram, because all of that information is in the histogram. Okay. So the MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. It's a 4-step removed indicator. That means it's a derivative. It's 4 derivatives, 4 sets of mathematical calculations that come down to that derivative. So what's the first? When we take the 12 moving average and the 26 moving average, because there we're deriving those moving averages from the average of the current price. So the current price is what is in actuality. The derivative is that's the first. The second is we're taking building the MACD line, which is a 12-day EMA less the 26-day EMA. We then derive that to the third calculation, which is the MACD signal line, which is simply a 9-day EMA of the MACD line above. And then we take that into the fourth derivative, which is the MACD histogram, which is the MACD less the MACD signal line. So the base for this indicator is the securities price. It takes 4 steps to get the actual price to the MACD histogram. Talk about massaging data. While not necessarily a bad thing, charters should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. So, as with MACD, the MACD histogram is also designed to identify convergence, divergence, and crossovers. The MACD histogram, however, is measuring the distance between the MACD and its signal line. The histogram is positive when the MACD line is above its signal. Positive values increase the MACD divergence. So after a while, you'll be able to see all of this together in that histogram. The histogram crosses the 0 line as MACD crosses below its signal line. The histogram is negative when MACD is below its signal line. So all it is doing is showing you how price is moving. You see how price is moving in the upper chart, and you see how the indicator is moving in the lower chart. We see the crossovers when we go above and below 0. We see the divergence when we can see the histogram pattern outshadowing the pattern of the chart. So in other words, we can see it right here. The histogram is moving this way. The chart pattern is moving that way. So what do we have? We have diverging patterns. Okay. When we see things at 0 and then breaking below, we have the 2 lines crossing each other. So there's all types of things. We're using the 0 lines, using the patterns they generate for trend lines. Everything you need is actually in that histogram. So it has become standard to plot a separate moving average alongside MACD, which is used to create a clear signal of shifting momentum. The signal line, also known as the trigger line, is created by taking the 9-period moving average. So if you think of the signal line as a trigger line, okay, it triggers you to action. And it gives you transaction signals. It generates the buy and the sell signal. So when this trigger line crosses above and below the MACD line, or it's at the 0, it's telling you to do something. So in the previous example, the various signals generated by the indicator are easily interpreted and can be incorporated into any short-term trading strategy. At the most basic level, the MACD indicator is a very useful tool that can help traders ensure short-term direction is working in their favor. Now, again, I warned you the drawback. The biggest disadvantage of using this indicator to generate transaction signals for buy and sell signal is that a trader can get whipsawed in and out of a position several times before being able to capture a strong change in momentum. As you see in this chart, the lagging aspect of the indicator can generate several transaction signals during a prolonged move, and this can cause the trader to realize some unimpressive gains or even small losses during a rally. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in the trader taking many losses. When commissions are factored into the question, the strategy can become very expensive. Another MACD drawback is the inability to make comparisons between different securities. Because the MACD is the dollar value between the 2 moving averages, the reading for different priced stocks provides little insight when comparing a number of assets to each other. In an attempt to fix this problem, many technical analysts will use percentage price oscillators, which is calculated in the similar fashion as the MACD, but analyzes the percentage difference between the moving average rather than the dollar amount. So in conclusion, the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crossover of the signal line can make it easier for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD. And this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So, if there's ever been a quest in the world of investing on par with the search for the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success, but a common trend tracking tool is the two-line moving average convergence and divergence. This tool measures a stock's momentum and can aid investors in spotting changes in market sentiment. So on that note, we're going to say good night to you, and hopefully you learned a little bit about MACD. It doesn't take long to master. It takes some practice. I've been using MACD for 20 years. I love the indicator, and after a while, like I said, you can see everything you need to see right in that histogram. You don't have to figure out what the lines are. You don't have to worry about the lines, and you can use it quickly and easily. And it works very well in connection with like an RSI or a stochastics indicator or a trend indicator or other momentum indicators. It works into anybody's strategy very easily and can be incorporated and learned and mastered in no time flat. So the strength of the current trend can be measured by channeling the MACD. Okay. So there are many ways to use it. So you can use the MACD histogram for both entry and exit points, but just remember, life happens. Trading is really black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. However, a logical methodological approach for violating these important money management tools needs to be established for attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea, divergence. So applying this method to the Forex market, which allows effortless scaling up of positions, makes this even more intriguing to day traders and position traders alike. So thank you very much. Have a very good night. Thank you for joining us. You'll be able to see a recorded version of this on the investing.com website under webinars recorded in about 24 hours. Thank you very much. And again, thank you for supporting CMS Trader. And you can use their charts for and use MACD on their charts, or give them a shot. They're a great trading platform. Have a good night now. And again, thank you for being part of the investing.com family. Good night.